Hello, good afternoon. I'm Erik Strid, and I'm CEO and co-founder of Consensus Wealth Advisors. This week I wanted to chat a little bit about a topic that's been getting a lot of play in the financial media and down in Washington among the regulators of the financial services industry, and that I think it's really important to have at least a basic understanding of, and that is the debate over what's known as the fiduciary standard. And basically there's a debate about what a fiduciary is, what it means to be a fiduciary, and who should be allowed or shouldn't be allowed to call themselves a fiduciary. So basically, in simple terms, if you type up on Investopedia on your browser on your computer, you get the definition of fiduciary, which is essentially a fiduciary is a person or organization that owes to another the duties of good faith and trust, the highest legal duty of one party to another. It also involves being bound ethically to act in the other person's best interest. And really that's what I think the definition of a fiduciary boils down to, is particularly with respect to a financial relationship, that an advisor is bound to always act in the best interests of their client. Okay? And so really what the debate boils down to is when does or doesn't a financial advisor experience conflicts of interest. Okay, when are there times that arise when me as an advisor might have a conflicted interest with you as my client? And really when I think about that, what I think is really important to understand is how the financial services industry has evolved over time. There was a time, I guess 20, 25 years ago, when many of the big, large, so-called broker-dealer firms, large financial institutions, devised this idea of a siloed approach to the delivery of financial services. And what I mean when I say that is, and keep in mind I'm a much better financial advisor than I am artist, but basically what they said was, if we could put all under one roof, one big silo, all the primary services that a client might desire, and that really boils down to three things, and that is first, advice. Okay, and obviously that's the financial advisor who you're working with and the delivery of the advice that you need to make good decisions. The second is custody. Okay, and custody basically means if I'm working with a Merrill Lynch advisor, then my money is held in a Merrill Lynch account. I get a Merrill Lynch brokerage statement every month and it shows me how much I have, and my money is held within the institution of Merrill Lynch. And along with the custody service comes things like reporting, what kind of statements I get, my online access perhaps, the performance reporting that I receive, etc. So custody is a key service as well. And then the final component is products and services. So in that arena, it's what actual investment products do I own? What kind of services am I obtaining? And there was a time when many big Wall Street firms felt that it's a really convenient package to be able to deliver to clients advice, custody, and products and services all under one roof, one-stop shopping. It makes it extremely convenient. So it wouldn't have been uncommon, and I'm picking on Merrill Lynch here, but 20, 25 years ago to walk into a Merrill Lynch branch office and you'd work with a Merrill Lynch financial advisor. Your account would be held at Merrill Lynch, and you probably would own a bunch of Merrill Lynch mutual funds. And so it was a really wonderful package. You didn't really have to go far to get everything you needed for a great financial advisory relationship. So the problem with that that has come to light and people have begun to understand is that when you tie any two of these elements together, what can begin to happen is you can begin to experience conflicts of interest. Okay, and when I say that, basically what I mean is, and I'll kind of explain a little bit, is that all of a sudden the advice becomes contingent upon the use of the custody or the products and services of that particular institution. So let me give you a couple examples. The first is what's happened in what I would call the large broker-dealer world. Okay, and so this is the industry that firms like Merrill Lynch, Goldman Sachs, Morgan Stanley, firms like this, they're household brand name firms. You've heard their names. You see their advertising on the golf on the weekend. And really what they've begun to realize over the years, or one of the areas they've been criticized for, is this idea of offering proprietary products. So what they've done is basically to say, okay, we're going to deliver advice and custody, but on the product area, we're going to deliver what we call open architecture. And basically what that means is they came under a lot of criticism that, well, if you walk into a Merrill Lynch office and they're offering you mutual funds that are Merrill Lynch mutual funds, those advisors have a conflict of interest to push you to buy Merrill Lynch mutual funds instead of buying Vanguard funds or Fidelity funds or something like that. And so you as the client really aren't getting what's in your best interest, which is kind of the whole world of financial products. You're only getting Merrill Lynch products. So these firms have done a really good job with developing an open architecture approach to products and services. So they basically now, if you walk into a Merrill Lynch branch office, you're going to have access to the whole world of financial products and services, because they've made arrangements with other mutual fund carriers and so forth to be able to offer those products. But what hasn't changed is the tying of advice and custody. So you can't walk into and I'm going to stop picking on Merrill Lynch. You can't walk into a Goldman Sachs office or into a Morgan Stanley office and say, well, I'd like to get my advice from you and I want to hire you as my financial advisor, but I want to custody my money at Charles Schwab. I want to custody my money over at Wells Fargo, or I want to hold my money at Fidelity or somewhere like that. No, the way it works is if I'm hiring a Morgan Stanley financial advisor, well, that advisor can only charge me a fee on and can only advise me on money that I'm holding in a Morgan Stanley account. They can't go advise me on money that I may be holding elsewhere. So they've tied the advice and the custody together. And really what in my perspective, that gives rise to really two primary problems. One is, what if you don't like the custody services of Morgan Stanley? You love your advisor, but you don't like the custody services that they provide. You don't like the way their statements look. You don't like the way their website access works. You don't like the performance reporting that they deliver. Well, too bad. You can't work with me as a Morgan Stanley advisor and go hold your money somewhere else and get access to different services that way, because you have to custody the assets in my firm. The other problem that gives rise to is, what if you're a client and there are certain assets that you own that you have to custody somewhere else? And the classic example of this is, I'm working with a Goldman Sachs advisor, and he or she is managing a portfolio of assets for me that are held at Goldman Sachs, but I also happen to have a large balance in a 401k plan with my employer that is managed by Fidelity. Okay, and just because my employer has chosen to use Fidelity for our 401k plan services, well, I have to hold my money, my 401k money, in a Fidelity account. Well, I can't ask my Goldman Sachs advisor to give me advice or guidance or investment recommendations on that Fidelity money, because he or she isn't capable of doing that. They're not going to be able to track the performance of that money for me. It's almost as if they have to basically ignore that money. And for many people, that 401k money may be one of the biggest assets of their household. But from a financial planning perspective, their advisor really isn't able to advise them on that money, and certainly not able to charge a fee on that money. So there may not be there may be a conflict of interest in that advisor acting in a comprehensive way with that particular household. Okay. The other way in which this kind of conflict can give rise is, I've noticed that many of the so-called discount brokerage firms, and the biggest, of course, is Vanguard. So Vanguard has developed now, in addition to offering mutual funds and products, is offering an advisory platform where you can go and hire a Vanguard employee to act as your financial advisor. And of course, they would claim that Vanguard is highly focused on client best interest, and there are no conflicts. It's a conflict-free relationship. But what I would wonder is, how is Vanguard operating with respect to advice, custody, and certainly products and services? So in Vanguard's environment, the question I would want to know is, my Vanguard advisor, I wonder if my Vanguard advisor is ever going to recommend for me to own a Fidelity mutual fund. Probably not. They have also tied advice to product. There is a situation where your advisor works for the same firm that is producing the products that you're expected to own, and that's Vanguard funds. Now, of course, Vanguard funds are wonderful funds. There's nothing wrong with Vanguard funds, but they're not the only mutual fund manager out there, and there are other good funds that are run by other reputable, strong fund companies, and which in some instances may be more appropriate for your situation and maybe more in your best interest. So basically what this does is it narrows the world and narrows the vision of your advisor to only one certain product set, which in my opinion is really not in your best interest. Open architecture is more in your best interest. So as you see, it's my perspective that anytime you tie advice to either products or you tie advice to custody, you run into a situation where that advisor is conflicted because that advisor has to use the custody services or the products and services of that particular institution when they're advising you. Now, the reason why we here at Consentus decided that the best thing for us to do was to leave the big, large Wall Street institutions and to start our own independent registered investment advisor firm was because that is really the only platform and environment in which we could break those ties. Okay, so we talk about a thing that we call the triangulation of advice. And all that means, it's kind of a fancy term that we came up with that basically means what we're trying to do is to triangulate, to separate advice from custody, from products and services. And I'm going to draw a dotted line between these three things and create a triangle. And basically what I'm trying to get at here is that in the environment that we work in, and we're of course not alone, there are other independent registered investment advisor firms out there, but basically our firm is an independent advisory firm. All we do is provide advice. We don't provide custody and we don't provide products and services or produce products and services. Of course, you have to have a custodian. You have to house your money somewhere. And we do have a relationship with the custodian. I put that as a dotted line. So in our particular case, we typically recommend that our clients custody their assets at Charles Schwab because we think Charles Schwab is a great custodian. But we don't care where our clients custody their assets. That decision is the only thing that matters to us is what's in the client's best interest. We have no financial relationship with Charles Schwab whatsoever. That's a third-party relationship. Now, of course, our clients work with us in concert with Charles Schwab. They authorize Charles Schwab to take instructions from us over their accounts and so forth. But we have no financial interest in where our clients custody their assets. So a client comes to us and for whatever reason, it might be in their best interest to custody their assets at Wells Fargo or at Pershing or at some other custodial institution. Perfectly fine. We have no financial interest in what they do there. And then the second is products and services. So of course, in a similar way, we don't produce products and services. We have no financial interest in any producers of products and services. So really what we can do is position ourselves as an agent for our clients and helping them to look at the world of custodians, products and services, mutual funds, ETFs, whatever it is that they may want to own, and really in an unconflicted way say, this is the best setup, these are the best products and services that you should own because we have access to all of them and we don't have any financial interest to you picking one over the other. So we really believe that this is an important thing for people to understand. It's only really now coming to full understanding from this perspective of most financial consumers. But I'm not here to bash any other firms. Some of the firms that I've named today are they're great institutions and there are great people who work there. I just think it's very important when you're hiring a financial advisor to understand that if there are structural embedded conflicts of interest in the business model, that you at least understand what those are. And certainly tying custody or tying products and services to the advisory relationship that you have automatically gives rise to the possibility of conflict of interest. So I hope that's helpful information. At least it arms you as a consumer with good information to make great decisions. And above all, we, as always, wish you all the best of success in managing your finances and living a great life.